Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now today we'll discuss a question that's very commonly sent to us by viewers, asking that how to turn a lump sum of say 10 lakh rupees into a reliable monthly stream of income. We'll discuss that and much more with our in-house expert Dhirendra Kumar. Welcome Dhirendra.
Thank you.
So let's begin with if I have a lump sum of say 10 lakh rupees, how can I derive a monthly stream of income from that? What exactly is SWP?
SWP is Systematic Withdrawal Plan. It is opposite of SIP, Systematic Investment Plan. It gives you enormous power. It gives you enormous flexibility. Most investment is all about, you in your years when you can invest, and then there are years when you can consume. So it is very helpful for retirees that you need a defined amount of money every month for your regular expenses or whatever needs, and you can do it in a predictable fashion.
All right. So say I have 10 lakh rupees. Can you demonstrate practically how can I withdraw each month?
It is a standing instruction that from this investment, give me back this much of money every month or every week. You have to be careful that how much you want to derive from your income. I would say that a conservative approach is to withdraw no more than 4%. A cautious approach will be 4%. Then there's a middle of the road, 5% withdrawal rate. So you have very little margin left, but still you have something left so that the capital can keep growing. And that is very important. Because if you consume all the returns generated by your investment, your capital will remain constant, and capital remaining constant is another problem. At a future date when your needs will grow, you will not have reasonable money. I think, a cautious approach will be 4% withdrawal, and an aggressive approach, withdrawal could be 6%, but no more than that, and then revise it every year. The years when you are lucky with the market has gone up, and then if the capital has grown, then 6% of the increased capital will actually be able to support a larger income. In absolute terms, though it will still be 6% of the appreciated capital. All these things, when I'm saying that 4%, 5% or 6% withdrawal rate, it is very important for investors to set the right expectation. Your investment will earn 8%, 9%, 10% or 12%, and in some years it will grow by 20%. But those 20% returns are not very predictable, or it is not very regular. It's once in a while.
And it's not a norm also.
It's also not the norm. And you will get also these nasty surprises where your capital will go down in value from the appreciated value. When you have accumulated some reasonable capital and then you decide to withdraw periodically from your investments. And if you start in a good market, then you think that, okay, this is the kind of return. Market goes up by 12-15%. And if you take out 12%, that's good enough. You are not unlikely to run short of money. It's very important to set the expectations and have a conservative expectation. Don't expect the market to do very well all the time. And of course, that is true. Markets don't do well all the time. Most investors all their life keep waiting for the most recent peak that the market achieved, keep waiting for it to regain. Have a long-term mindset, because you have to think that you are going to really live longer, and you have to make sure that your withdrawal from your capital through SWP is not of a kind where your capital will get exhausted.
Right. Now, how should I structure a portfolio to support this kind of SWP?
You need to plan your systematic withdrawal plan very methodically. For regular income from your 10 lakh rupees investment, I will suggest a simple plan. If your need is higher, if you have aggressive expectation, then invest in an aggressive hybrid fund. That is 75% equity, and I'm hopeful that over any prolonged period of time, 3, 4, 5, 7 years, it will be able to support something like 6% annual withdrawal. If you are reducing it to 5% is good enough, then maybe a balanced advantage fund. If you are looking at 4% and want to be very careful with your capital, don't want it to go down, then maybe a conservative hybrid fund. This simple investment, one investment and mounting a 4%, 5% or 6% annual withdrawal is supported. But for somebody who has 50 lakh rupees or a lakh or a crore of rupees or 2 crore rupees and has far greater dependence on monthly income from this investment to support all his life, then he needs to work little more methodically. And there I can make it a little more sophisticated, little more complicated, though principally it is simple. But it will apparently look little complicated because you'll have to take 2-3 actions. You will have to decide that how much money you need every month. Make sure that you still follow the rule of 6%, 5% or 4% depending on how much capital you have. And first 2 months income requirement, that money you invest in a liquid fund or a short-term debt fund so that you have absolutely no anxiety about your eroding capital. The money that you are unlikely to need for, the money that you will need in 3 to 5 years, invest that money little conservatively into one of these balanced, there's hybrid alternatives, balanced advantage, or even more short-term debt fund if you want to be more conservative. And the money that you are likely to need after 5 years, all that capital should be invested into flexi-cap fund or aggressive hybrid fund or a multi-cap fund or a combination of equity fund. Even some, aggressive avenues like opportunity fund, focused fund, or funds that you like, and they can be more volatile, can be combination of small cap, mid cap, because then you will be assured that you don't have to touch the capital that for next 5 years, which will be very volatile. The money that you'll be consuming in recent future, that will be in assets which will be absolutely, it will not be vulnerable to the market movements. It will only keep going up, and this will save you a great deal of anxiety. And I'm hopeful that you will end up having the capacity to support or derive a much larger income over time.
Right. Now, what should be the return assumptions or inflation step-ups or downturn rules that I should apply to this plan?
You should not have a downturn rule if you are allocating money like this.
Okay.
The 2 years income need, if it is invested in ultra short-term bond fund or liquid fund, that is, you don't need to do anything. You don't even need to rebalance. You don't even have to be concerned about it. The money that is invested, the money that you'll need in year 3 to year 5 will also be invested in relatively conservative avenues, which will grow. And the money that you will require after 5 years, that money should be in equity, and your need for income should be updated every 2 years. So if once you add up the investments every 2 years, you will realize that what is the total capital, revise your 6% based on the revised capital. So your need for and if your need for income is lower than that, then more capital accrues to you, and that keeps getting stored. So this is something where I would say that all these things are very dynamic. If inflation rate in India comes down to 1 or 2%, then even a 5% interest rate could be very high, and even a 7% equity return could be very handsome. Today, we don't look at if you earn 5-7% from equity, people will be very disappointed, and understandably so, because inflation is so high and we experience it every day. So this is a very dynamic thing. The return from equity is also a function of the risk that you assume. If the corporate governance in India has gone up, if the number of companies which disappear or run away with investors' money has come down, then that equity risk has also come down. So the premium that you pay for what you're buying, the risk associated with it. So with that in mind, I would say that having this, you keep your goal aligned with your conveniences. Do your allocation, invest in a manner which is very much suited to your requirements.
Now, one last question, and one that is sent in by a lot of investors. How are SWPs taxed? And is the income distribution capital withdrawal plan, the IDCW plan, is it better in any way?
SWP withdrawal is taxed as your income, particularly the plan which I am referring to. And it is very straightforward. The return, the units that you redeem, only the gain component of that. So if you invest all your money today and start withdrawing that, assuming 6% of that money every month, 6% withdrawal annually, which means 0.5% withdrawal of your capital every month. And if you're doing this, then only the gain component of the units that are redeemed in the first month is taxable. If it is an equity fund, then it is taxed at short-term capital gains in the first year, and after that as long-term gains. In the first 2 years, from the liquid fund and the debt fund, it is treated as your income. And if that income happens to be lower than your taxable bracket, then it's a different story. So it is taxed, and choosing the dividend plan, now called IDCW, is not desirable because it lacks the predictability. It is dependent on the performance. It has to be paid out of the realized gains from the fund. So you can't bank on it. The systematic withdrawal plan gives you the opportunity, or gives you the confidence of having a predictable, regular withdrawal, revising it annually. Set up your SWP for 1 year, revise it every year, or do it for 2 years and revise it every 2 years. You will have the headroom, you will have the control. So for convenience and control, I think SWP is better.
Thank you for breaking it down so clearly.
Thank you.
Moving on to the viewer's question now. Tapas Majumdar has sent in this question, and he says that in a recent session, you recommended conservative hybrid fund over fixed deposits as it is expected to give additional return. But there is no tax benefit as it will be charged at slab rate. In addition, if one has income below 12 lakh rupees, as per new scheme, he still pays tax on the gains at slab rate as 87A benefit will not be available for short-term capital gain on debt funds. So if you could please elaborate on this.
Yeah, it is taxable, and but it doesn't make a difference because fixed deposit will give you fixed return. My expectation from conservative hybrid fund is that you will be able to beat fixed deposit return. It will be taxable, and it will have all the convenience. But the biggest advantage that you derive from conservative hybrid fund is that in fixed deposits, every year you earn interest. Even if you don't take it out, it is a taxable income. Here you are not liable for paying taxes till you realize it. So if your conservative hybrid fund, it turns out to be for 4 years, it is lying there, it is appreciating, it is earning more than fixed deposit. And till you take it out, it's not taxable. Every mutual fund turns out to be a great tax deferral vehicle.
Okay. So thank you for watching Investors Hangout. That's all we have for you in this episode. Keep watching the space for more information and keep sending in your questions. We'll try and answer as many as we can. Thank you.